going forward as well. Sharp pullbacks notwithstanding. Aditya Narain is with us, Managing Director and Head of Research at Edelweiss Securities. Aditya, great to have you with us here. Appreciate your time. Your thoughts, Aditya? We've got 400-point moves. Should we expect more of this, or do you think things will settle down sooner?
I mean, this has been phenomenally unusual to have every day being so dramatic and in different directions. So I'm not sure if you can get a repeat of this. But I think you will continue to see a certain amount of volatility over the next couple of weeks. Though I would tend to believe that, beyond that, you can't have sustained volatility of this order for very long. And I think it will start petering out a little bit. You see, I think what's happened is that at the moment, what the market initially reacted to was really rate hikes and the impact in terms of valuations. And now I think you're moving to growth fears. So I think, that transition is where you're seeing this volatility. And that's where you are at this point in time. But I think the last week or the last 2 weeks in the US in particular seems to suggest that you're now looking at growth risks. And so to that extent, when it's a single risk or there's less of transitioning that is going to happen, then I think the volatility will tend to ease off. The market might become a lot duller and a lot slower than what it has been in the last week.
Okay. Aditya, hi, welcome to the show. I wanted to ask you how you would approach stocks such as Reliance now, because that saw quite a surge in the second half of Friday's trading session. Would you put your money into large conglomerate companies where there is less of a risk when it comes to earnings now?
So I think, this environment, I think one thing you must keep in mind, because it's often being compared to the slumps that you've seen in India before, and that is balance sheet risks or leverage risks in the corporate sector. Those are relatively low. So to some extent, a lot of volatility tends to come out of that. I think that is pretty modest, and it's a very good thing that is going for India at this point in time. The debate is more around the P&L, which doesn't tend to move stocks very dramatically. So I think that's one element of it. In terms of stocks like Reliance, I actually tend to believe that if there is going to be an enduring theme over the next couple of quarters and potentially beyond, it's just really going to be this whole energy scarcity and energy premium kind of theme. And I think Reliance tends to fit in well there, whether it is a little bit on the petrochemical side or the oil side or in terms of the new energy side. I think that space is just going to get revalued a little bit. Simply because of the scale that you've seen at this point in time and the fact that oil prices and oil derivatives have gone up as much as they have. So I think you will see safety in companies which are aligned with the oil theme or the energy theme. And I think that is something that works to Reliance's favor. Whether it's a conglomerate theme or not, I'm not so sure. I think the oil theme or the energy theme will tend to be a little bit more dominating.
And Reliance has got, in terms of energy, new energy, old energy, has got the works. Well, Aditya, I want to ask you about IT, but let's just set this up with Rima, who's standing by, with a quick sense of what really happened, because that was the one space which was bleeding sharply at one point, stabilized towards the close of the week, but Rima will tell us more. Rima.
Thanks so much for that. I'm smiling, but IT stocks took a tumble this week, extending their year-to-date losses to more than 25%, mirroring the sell-off that we had in NASDAQ. And now increasingly, there is so much chatter about a US recession, a global recession, and that's going to hurt technology spending, which will eventually slow down growth for the IT services in the next 1 or 2 years. Also, market fears that consensus expectations are way too high on margin front. So there is a margin risk going into the rest of the year. This week, we had brokerages bring down their outlook on the IT sector. So JP Morgan downgraded the IT sector to an underweight. They cut the target multiples by 10 to 20%. And here I'm quoting from the JP Morgan report, rising margin headwinds in the near term and revenue headwinds in the medium term from a potential macro slowdown will mean the sector's earnings upgrade cycle is behind us. It wasn't just JP Morgan, even Nirmal Bang. In fact, Nirmal Bang has downgraded their assessment on IT sector for the second time in the last 3 months. Now the rating on the IT sector is that of a sell. And look at the way year to date now these large cap IT stocks have tumbled. We've seen losses of 35–40% coming through for Tech Mahindra and Wipro.
Rima, thanks very much for that. Aditya, is tech still slated to eat the world, as they say? And would you buy stocks here? Go on.
Okay, so since we've dialogued on this over an extended period, we had been for some time actually very much on the bullish camp. We are kind of tempering that view. Now that's on in part on two elements, not what you're seeing bottom up. Quite honestly, bottom up, if you listen to managements, if you see what's going around, I think order books, the outlook on orders, and on revenues continues to be actually very, very positive. I think what has happened is that you're just getting a macro pressure point in that, people are talking recession and people are thinking recession, and the risks of something like that happening have effectively gone up. So it's not what you see at this point in time, but what the market is anticipating 12 months, 18 months down the line. I think that is where the challenge has effectively come up. So you had that element where there has been a shift, and I think, quite honestly, in the US, it's been pretty decisive over the last fortnight. The second element is that I think the cost pressures that these businesses are facing, they're tending to extend a little bit beyond. And I don't think that will ease off necessarily very quickly. So I think that, I think Rima made that point that margins could be under pressure. I think that it starts playing through. And I think the third thing is that valuations are at the end of the day on the higher side. They're one standard deviation above their means. They're still well above pre-pandemic levels. And I think that combination is actually at the end of the day tempering what was a pretty bullish view for an extended period of time. So I'd be a little bit more cautious on them. I'd still say the risks are not necessarily very pronounced because stocks have come off a little bit, but they just might be laggards in any rally that you see, either from a top-down perspective or from anything that's more local that might play through.
Okay.
So a little bit more tempered out here, simply because of the overhang of that so-called recession and the possible implications as far as the demand books are concerned.
Okay, so you're tempering your expectations on IT, but what about metals, Aditya? Because metals rallied 7% this week and China's cut rates. Would you put incremental money there?
We have very low expectations. There is not a question of tempering expectations. We think if you can be so cautious on IT, or if the market can start extrapolating risks to growth on IT, I think they would be more pronounced as far as the metal space is concerned. So we are actually running a zero weight in our model portfolio. And while they've generally held well, in the light of the broader macro, I do believe that if let's not say worst case scenarios, but if difficult case economic scenarios play through, metals will probably tend to lag a bit. You must also remember that the operating leverage for these stocks is very, very high, very, very price sensitive. So the volatility around them tends to be very large. So if you're bullish on the market from an overall context, that'd be a place to go there. But if you're a little bit more circumspect, then I think metals you need to be much, much more watchful on.
Aditya, is it too early to come out with top 5 stocks to buy in this drawdown kind of a report, or is it?
Well, we need to do that all the time. So I don't think it's
No, it's not about you, but you think that we are at that point where, it makes sense to do that?
So I think what has happened is, you see, if you were to look at the Indian market, there was a point in time, literally a month ago, when it seemed, fairly overvalued. I think the overvaluation has come off, right? So it does make things a little bit more attractive. I think the challenge that you face is in terms of whether growth risks for the domestic market are fully factored in. And I suspect not. I think the valuation froth has come off. The growth risks, I think, are still slightly embedded and are not fully factored in. So it's not like a time where you go in and say, this is the time to buy. But I do believe that there are certain themes that you can play very comfortably. There is the two-wheeler theme, which we are comfortable with. There is the private banks and the private insurance theme that we think one can be very comfortable with. And at a portfolio level, I think pharmaceuticals with an India market bias, I think that's a place to be fairly comfortable. So I think there are small pockets of value. It's not undervalued, as it were. But if you have money to deploy, we can find you places to deploy money.
Okay, definitely, Aditya. So we'll definitely touch base with you on those ideas which you're probably propagating at this point in time. It's been a pleasure. Thank you very much for joining in and speaking with us on CNBC TV18. Time for a short break now.